Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Meredith, welcome back to the show.
Thanks again. Good to be here.
It is indeed. We were at episode 4 of 5. So the last episode on our passive income series will be Q&A. We've already received a lot of questions. If you are watching or listening right now and you do have questions for Drew or I, you can send them to podcast@rask.com.au. We are going to spend probably about an hour answering those questions because there are so many that we've been sent. Anything investing, portfolio construction, financial planning related is what we want. Mate, today we're talking about a hypothetical scenario that I've given to you. You've got about just like 10 pages of notes here that I've just been sifting through. So I'll get to...
Probably the same thing I do for every meeting.
Yeah, you do really well. And unfortunately, you did it in different colors so I can see everything. It's really good. So if I'm shuffling papers or if you're listening and you hear me shuffling, that's what it is. It's all Drew's notes. Maybe I should start with the scenario. And the scenario will be in the show notes if you do need to refer to it. So I'll just read it straight away. So Jane is 51 and Rolf is 52. They live in Brighton Le Sands, which is New South Wales. I chose that suburb because that's where Raymond Jang, who is regularly on the show, that's where he lives. They live in a 4-bedroom, 2-bathroom house. Rolf is a sticky-fingered accountant, earning $110,000. He loves the Hawthorn Hawks and the AFL, obviously, and spends his weekends watching their 2 boys play sports. Jane is a midwife in Sydney, working 7 days of night shift every fortnight. It's a good gig, I believe. She earns $115,000, also on PAYG. Jane uses some of her spare days off to volunteer at the food bank, encouraging her 2 sons to get married and have children. So very cliche. The financial picture is as follows. So they've got assets. They've got super. Ralph has $340,000. Jane has $260,000. Their house in Brighton Le Sands is worth $1.4 million. They have an investment portfolio of $185,000. And I'll just be brief here what they've got. They've got the Argo LIC. They've got Vanguard VAS, the IVV ETF, a Magellan ETF. They've got BHP and CBA shares. But then they've also got a crypto ETF, which has $5,000 in it. It's a bit random. Outside of their brokerage, they've got cash and term deposits of $70,000. And in their offset account, they currently have $35,000. Against their assets, they have liabilities, mortgage of $450,000, credit card of $8,000. The 2 boys are 17 and 19. They both live at home, so they have massive liabilities, I can imagine. and then we've got a car loan of $34,000. So some other things that are worth noting for this, Drew, is we've got insurance is held inside super, so the 3 usual suspects in there. Ralph is an only child and could be expected to inherit $300,000 in 5 to 10 years. Who doesn't love to talk about that stuff? Okay, so I'll give you the goals and then we can just start on some prompts. So for Jane and Ralph, they've heard they could retire and earn passive income of around 4% per year. That's after inflation. Obviously, we've got 5% at the moment at the time of recording, which is pretty high inflation. They're hoping to earn between $60,000 and $80,000 in income in today's dollars. They both want to retire between 60 and 65, debt-free, so that's around 10 to 15 years. They don't want to move or sell their house, because they love that part of Sydney.
At the moment.
At the moment, yep. Maybe in a few years if they want to downsize. But would be open to downsizing once the kids have moved out. Being an accountant. Now, I think you might take offense to this one, mate. Ralph is more risk averse. So I've been very stereotypical here. So he is much more concerned about capital loss than Jane seems to be. She is a high risk / growth investor if she does her risk profile. Jane and Ralph would like to spend 4 weeks per year on a holiday, either locally or internationally after 60. So basically that would mean like every other year they go to Europe and New Zealand, something like that. Just a comfortable holiday away, nothing like they're not staying in Monte Carlo Casino or anything like that. And Jane would like to build her wealth outside super and the house. And Ralph obviously likes the tax advantage status of super. So maybe just a quick one before we get into the structured questions I've got for you. Is this a typical scenario?
Yeah, I think it is. People, we've talked about this kind of nowhere period before where, your children in that peak schooling age, your 40s, you're paying down your mortgage, you're paying a lot of expenses, you're paying for 4 people, and you're probably entering 50 plus is where your key part of saving is. So I think it's very typical, and a lot of people or professionals, so accountants and midwives, in this kind of situation.
Yeah, it seems like probably the one. I don't know if this is realistic. So to your point, I guess maybe they are 50. So a $450,000 mortgage against a $1.4 million home. If they've been holding it for 20 years, it's probably reasonable.
Yeah,
yeah.
It's probably tracking normally, just paying the minimum repayments. You can see from your assumptions that they've only got 35 in the offset. So minimum mortgage over something like 20 years with 10 to go.
Here's a question for you with your clients. Like, say they have 2 boys, one's 17, one's 19. So my assumption here would be that maybe one of them has 2 years of school, like he's currently this year and next year.
Yep.
What does the private school fees cost? I feel like it's pretty high.
I'm looking at, I've got 2 boys that are 1 and 4, or nearly 4 at the moment, so I'm trying not to think about it too much.
Yeah, right.
Jamie, my business partner, has 3 kids, I think mostly in private school. They can go anywhere from the 35s, I think, to $60,000 a year, which is an important expense for a lot of people. And how do you plan for it? Some people set up sort of family trusts and invest separately. Some people just view their own assets as set aside for school fees. But definitely something you need to prepare for.
Yeah, we've done an episode on the Australian Finance podcast. We did quite a few years ago. We looked at the payoff. Basically, there's been a heap of studies done that may show that you could probably just take the money, the $200,000 or $300,000, and invest it for them and help them other ways.
Well, prepayment is also an option. Apparently,
you can
get
lower the prices.
So.
Yeah, so and the more kids you have, the more you save. I believe so. That's financial advice 101. There we go. Okay, mate. So let's just talk about it at a high level then. How do we take what I've just given to you? So all these assets, all these liabilities, how do we take that? It's kind of like a medley of things and put it into something, structured.
The first thing we try and do is find holes in the story. So the first thing I saw was that they live in Sydney, but they support Hawthorn. That was the first.
You can't help but have good taste,
call
mate.
out I had in there. But seriously, it's a massive amount of information gathering. So there's all kinds of questionnaires, getting statements, finding out the specific details of every account, every asset they own. Mm-hmm. Taking a couple of meetings and asking probing questions on different areas. Are the things they're saying matching up to what they're actually doing? So similar to the Hawthorn concept, but if they said they're saving $10,000 or $50,000, whatever it happens to be, are they actually doing that? Is it showing in their superannuation or their other assets?
Do you find? Sorry, just to interrupt. Do you find that people clean for the cleaner in this regard? Like they try and make things look good, and then they come in, it's like a confession. They come in and they go, oh, we've got this and we've got that.
They never really confess. You just kind of work it out over time, and you know the signs.
What would be a sign?
What's a sign? Yeah. Well, when you say you're saving $100,000 a year, but you have no savings, it's usually a good sign.
Okay.
When you come in, I think the problem with everyone does a budget, and they tend to do a forward-looking budget. You probably talked about this too. Whereas the most powerful budget is one that looks at what you've actually done. There's no point having a budget of what you're going to do, because we know things always change. So you should assess what you've actually done when you're seeing an advisor. Find out what you've actually spent over the last 6 months. To get a real understanding of what you're saving. So I think that's probably an important one. Asking all questions around their experience with investing, what are they trying to achieve, what sort of income levels, which you've kind of identified in the goals. What have they invested into in the past? You've talked about one being risk-free and one risk-averse. Why? So I don't assume accountants are all conservative, but what is the reason for that? The other one, you identified superannuation, that one person preferred super, the other one didn't. So understanding why that's the case. A lot of the first meetings are kind of almost behavioural and talking to people about the kind of preconceived notions of investments. And then it kind of moves into the nuts and bolts. So what specifically do they want to achieve from this?
Yeah, right. Do you find that people are reluctant to give you everything? I've heard some stories in the past. When I was studying financial planning, I heard stories of people that would not divulge all the information because they, for one reason or another, maybe they don't trust their advisor, maybe they've had a bad experience, maybe they don't really talk about it with their partner.
Yeah.
Do you find that?
It has been a problem. We, as a kind of boutique firm, we don't deal with massive amounts of people, and essentially we won't take the initial meetings until we have a full questionnaire and full background of what those assets look like. Otherwise, you spend a lot of time trying to catch up to what you need to provide advice. So we're under the recently introduced legislation. We actually have to consider all other assets and the broader financial impacts of advice we provide. So you don't really have a choice as an advisor to just go, oh no, they don't want to tell me.
Yeah,
they
didn't mention that. Like this.
You can't assume away anymore.
Yeah,
which I think is great.
It's more transparent for the whole industry, isn't it? Okay, so we've got like a pretty good super balance from Ralph, 340, 260 from Jane, which they'll probably work on. Got an investment portfolio of 185,000, 1.4 million in the house, or value of the house. They got 70k in TDs in cash and 35k in offsets. So just to rehash the assets there. What are like 2 or 3 easy wins? Like what could these guys do just straight off the bat? You're looking at it, okay, interesting.
The first thing I saw was why hold cash and term deposits if you've got a mortgage that's non-deductible, particularly relevant now that interest rates are going up on mortgages. I think CBA increased by 1.4% or something today.
Yeah, I think, something like that. 1.4.
So, you're holding cash, your offset can be treated like a cash account the way I manage my mortgage. So why hold cash that's returning nothing while you're being charged interest on...
And tax.
Yeah, exactly. So one easy one would be put all your cash and term deposits into the offset and effectively you're getting the guaranteed return of the variable home loan rate because you're not paying it anymore. The other one, we review insurance to make sure a lot of people can be overinsured depending on who set up your insurance, the timing, if your circumstances have changed. So make sure, 1, they're not overinsured, and 2, that their policy premiums are competitive. Most are these days. There's not a lot of difference between insurers, but making sure that, they aren't ridiculous.
Is it pretty common that they have their insurance inside super, so income protection, life and TBD?
It is fairly common, particularly with probably industry funds and then corporate super. So if you were part of a bigger firm at some point, you would have been defaulted into super. And most people hate outgoings and expenses in their own income. So
then it's real, right?
Yeah, putting it in super,
it doesn't matter.
It's a kind of set and forget for a lot of people that way. I mean, the other one was you only asked for 2, but I'll give you 3. Was just to review their superannuation. So the default nature of super means you could be in a fund that's not performing particularly well, it doesn't match your circumstances, fees are high, it could be a corporate plan, it could be an industry fund. So what are you paying for it? What investment option are you in? And make sure that's aligned. Yeah.
How about, I didn't put it in the notes, but how about if, say, someone come in, like say Jane and Ralph, they're in some corporate super fund and they notice that the fee's 1.2%.
Yeah.
Is that too high?
I think so, yeah. I mean, you think the average, if you're talking investment fees only, because obviously there's advice fees and investment fees, you always compare it back to an industry fund, and average industry funds are about 0.7, 0.8 for investment only. So 1.2 is expensive compared to them. And then you consider, obviously, fees aren't the only thing, is performance up to scratch. And usually if fees are high, performance isn't always
as good. Okay, but there's a risk, right, with changing super because you could lose insurance and stuff like that. So is that something you take into account as well?
Yeah, a key part of the process. So probably going back to the first part of the question is the first question is the process of providing advice. So it's a massive amount of information gathering. Then we'd usually provide a scope of advice that we'll send to the client to approve and prepare what in the industry is known as a statement of advice. We split that into strategy and investment, so almost 2 documents. And strategy is everything from superannuation, contributions, reviewing your insurance, putting forward recommendations for each part, and then telling you what the risks of doing that are. So if we're going to recommend changing superannuation plans, we have to consider what the implications are for insurance. Does that mean some cases we'd assist with applying for insurance in a new superannuation account, or it could be if you keep a minimum balance in the super account, you can keep your insurance and roll the bulk of your balance somewhere else. Yeah. Quite often. I mean, I've got my insurance at an industry fund, but I run an SMSF, so it's kind of...
Yeah, well, you get the group insurance, because you're your policy, your risk is spread.
I won't say which fund it is.
Yeah. Okay. So speaking of super, they kind of have different opinions on whether they should build wealth inside or outside of super. So obviously we've got Ralph, the accountant. He likes, he knows the tax rate's 15% for his super fund.
Yeah.
Jane's a bit more hesitant. She's heard things like, then the money's locked away to retirement and all that sort of stuff. Would you advise them to build wealth inside or outside of super, or both?
On a broad basis, we'd generally suggest most people try and have 2/3 of their retirement capital in super at retirement.
2/3,
and
right.
1/3 outside.
Okay.
I think you got a follow-up question later on that talks about when super becomes appropriate. I think as you enter your 50s, noting that you can't access your super until you're 60,
Yep.
and then depending on what stage of life you're in, are you got a lot of debt? Are you changing jobs? Have you got a lot of savings capacity? You'd probably start considering super at the moment. And I think by far, superannuation is the best entity through which to hold your retirement assets. As you said, it's not just the 15% tax rate on income now. It's the fact that it's completely tax exempt once you start drawing an income from your superannuation.
Yeah.
You don't pay tax when it comes out either. So I'd convince as much as I can Jane to embrace super at the appropriate time.
Yep.
But I think, that 1/3, 2/3 split is kind of a rule of thumb we use.
Would you say so they're on 110, to say roughly each 20, so how much would they be contributing? Say 10%, so $10,000, $11,000 each. Concessional contributions, $27,500.
Yep.
So they've got 15, 16 grand that they could top up. Would you maybe suggest that as something they could look at, or?
Yeah, I'd put it forward, probably not to the full limit, depending on, obviously we look at the marginal tax rates and how much additional tax you're paying versus contributing to super, plus they have a mortgage they're repaying. So you'd probably look to top it up a bit just to have more disciplined saving.
Yep.
But always wary that most people's main objective is to pay off their mortgage before putting more into super as well.
There's actually something that I thought about this morning before we recorded this, that some people probably aren't aware that you can now use unused concessional contribution caps.
Yep.
Is that right? So can you just explain that for people that might be listening?
Not the peak of my specialty, but I think there's certain, if your balance is below $500,000, you can use concessional contribution up to that $27,500, which used to be $25,000 for the last 3 years, and do catch-up contributions and essentially get the tax deductions associated with them as well.
Yep.
Which is, I think, powerful for people like this that are nearing retirement and about to go through a period of heavy saving.
Yeah, because if they didn't have a mortgage, probably the next best thing for them would be superannuation, right?
Definitely.
So then they could make use of something like that if they weren't aware. That's something. We'll put links in the show notes to the ATO website for that as well. Okay, so...
And that's something that forms our advice as well. So within the statement of advice, we'd say, here's a contribution strategy, here's what you can do, and here's what we recommend over the next 10 years, how much you can contribute each year and what the result is.
Actually, I'll hold that question for a minute. Okay, so the benefit of putting extra money in super is the tax benefit. Are there any other benefits associated with that? Like, what would be the risks to doing that? Is it just being locked up?
So you get the tax deduction. Obviously, you're reducing your taxable income by the amount you contribute. If you contribute outside of your salary, you get a $1 for dollar tax deduction. The income tax rate is only 15% in superannuation, and the capital gains tax rate is effectively 10% on realised capital gains. The negative is you can't access it until you're 60, so at least 60 essentially. So massive tax benefits versus preservation is what it's called.
Okay. And you said that once you hit 50, that's when you might be starting to take a serious look at what you're contributing and how you can use that more effectively.
Yeah, very lifestyle based as well. So if you've got $1 million in debt, you probably wouldn't even, and you want to repay it before you retire, you probably wouldn't even think about contributing until that's down to a more controllable level. But from 50 onwards is where we most regularly see the best opportunity, and the 8 years from retirement accessing your super is a bit more comfortable for people to start allocating capital away. And then that assumes you don't want to buy a holiday house, you don't want to do something crazy or or major, start a business or anything like that.
Speaking of something crazy, I'm sure there are some folks in sandals licking their chops at the equity that's been built up in this house. So they've got a $1.4 million house and $450,000 mortgage. By my calculations, that's about $1 million in equity. I'm sure there's some property spruiker out on YouTube that would love to take that equity and roll it into something. But even me, like if I look at that and I think, well, that's $1 million of equity, I wonder if I could redraw that and use it in other ways. What would you say to something like that? Would you pay it down? Would you advise?
We're very much about take as little risk as possible to achieve the goal that you want. So on their current situation, is it possible to generate the income they want? Because obviously introducing additional leverage at this point locks them into a strategy and increases the range of outcomes. I think naturally people want to use that equity.
They could say, well, I'll go and buy that investment property, which you were just saying, I'll use equity for it. Don't have to outlay any cash.
Yeah, exactly.
Yeah.
Then you end up paying more debt, and you're risking things like interest rates going up and going negative, or the returns on that aren't as good as expected. So we say we're probably more conservative. Most of our clients are closer to retirement than this one, would probably be my excuse or response to that.
Yeah.
Usually if you're in your 40s, definitely. As you're getting closer and given your retirement dates within 10 years, the balance is getting a bit more difficult to justify, I think.
Well, there's a risk to every, reward. In this case, if you take on that risk, it's a lot. Who knows how long the mortgage is for, and when you refinance, and your job, security and all that sort of stuff comes into play as well.
Yep, exactly.
Yep.
And you're locking a large amount of your asset base into single asset class, if it's property particularly.
Yeah. Okay, so for those people that, I don't know if I've mentioned this, I feel like I have before. The episode that we did on this type of scenario where I just quiz you with questions was actually our second most popular episode ever. Had you and Jamie on the show to do it last time. So one of the goals for Jane and Ralph was that they would love to earn between $60,000 and $80,000 per year from their portfolio, their wealth overall, once they hit retirement. So that's in today's dollars, and they don't plan to retire for another 10 or 15 years, say. What type of nest egg would they need to earn that?
There's a bit of a mixed selection or mixed bag of forecasts that people use for this. So we have a simple rule, and we work generally on the assumption that our clients want to leave money to their family and children as well as the house. Mm-hmm. But we also know that people don't know when they're going to die, to be super dark. So a lot of the modelling, I found I think it was on CanStar, that talked about this type of person retiring at 60, wanting 70 grand a year, would need about between 1 and 1.1 million in assets. But most of that modelling is based on the assumption that you live to your life expectancy, not less, not more. And I think I've discussed the rule of thumb before, that we have a very simple assumption that has changed in different market environments, which is you should be able to generate about 5% in income from your portfolio each year. So that puts the $70,000 income at about anywhere from 1.2 to 1.6 million. So about 20 to 30% above the kind of life expectancy assumption, but it gives you more of that buffer that you're not on your last dollar when you're on your deathbed, which is kind of trying to keep it bright, not dark.
No, that's fine. So basically you're saying 5% income. What about CPI? Does that factor in here?
Yeah, so that's just the income production of the portfolio, whether that portfolio's got term deposits, bonds, Aussie equities, domestic equities, alternatives. CPI and growth would be on top of that. CPI is challenging at the moment with inflation at 5% and 8% or 11% in the UK.
Yep.
But over the long term, it's still sitting at about 2 to 3%. So essentially, you want to the issue we see is a lot of people focus only on the income and the income they can produce. But the problem with that, as you would have seen, if you're buying assets or companies that don't reinvest in themselves, you get a company that goes nowhere or goes backwards. You're effectively investing in a bond. Where I think the most important thing when you're trying to generate income over 30 years is that your income is growing along with your capital. So I think that growth, I think the typical objective is about CPI plus 4 to 5%, which just kind of fits in there. So they get their 5% in income and 2 to 3% in growth.
Okay, that makes sense. Because that's the question on everyone's mind is like the rule of 4, which like the safe withdrawal rate basically assumed 3% interest, 3% inflation, right? And so you're saying the big question is, do they want to leave anything to the next generation? Because if they don't, then they can die with 0 effectively. Yeah.
And what probability do they want to put around it? I think we mentioned in here the asset consultants we work with do probability analysis of different outcomes and different asset allocations, and they can tell you based on buying Aussie equities or domestic or global equities, the probability of basically 10 CPI plus everything from 0 to 10%, and you can see the probabilities go quickly negative or positive on a few different changes in there.
Yeah, right. So so that's actually a good segue into this question is then how should they, like, what would their strategic asset allocation look like? We've talked about in the episodes gone by, we talked about the 4 buckets. You've got defensive, alternative defensive, growth, alternative growth.
Yep.
If you want to break it down that way, you could, or you could just say, risk on, risk off, or bonds versus stocks. However you want to frame it, what kind of return would they need? What kind of portfolio would they need to match that goal?
In retirement, so I said you'd probably be more aggressive now in their 50s. So you'd be looking anywhere up to 15% in defensive and the rest in growth. And that defensive, because they can't access the super, and most of it's going to be through superannuation, is more there to have capital to deploy into markets at times like the moment.
Yep.
That would naturally de-risk as you got closer to retirement. The 5% assumption we have comes from a balanced growth portfolio, if you want to call it that, which is closer to, say, 35 defensive and 65 growth, not a traditional balance, which would be 50-50. So you do have to take a bit more risk to get that kind of income. And then within that, we try and balance the need for income and growth, as we were talking about before. So you'd usually split equities evenly between overseas and domestic, and then you obviously get better income from domestic equities and better growth from overseas historically anyway.
So that's how you would tilt the portfolio if you
as a starting point, and then you kind of work back from there to adjust for people's comfort, the types of instruments people prefer to invest with.
Okay. So we just talked about retirement and leading up to retirement. One of the things that I see a lot of people kind of debate with when they get to this period of their life is, well, maybe a few years on from these guys, is they think, should I keep working even part-time?
Yeah.
Are there advantages to that, do you think?
I mean...
like we know that there's money coming in, but any others?
Yeah, if you know you're in a reasonable position and you've got enough to retire... we, as an advisor, we tend to do more of this behavioural and personal advice than we do the financial part. Like most of our meetings are about family or other challenges going on in people's lives. So I've found people who work longer tend to live longer, which is, I think there's probably data and confirmation of that.
Yep.
And, a finite end to work and then going out into the world with maybe playing golf and that's it. It kind of, you need a real ecosystem of things to do. I know a lot of clients we speak to are actually more busy now than they were when they're working, but half of it's, some volunteering, some paid work and babysitting, unpaid babysitting is pretty big. So generally I've seen it positively for most people continuing to work, and you get the added benefit of money, but I think also not, most people's social communities come from their work, and a lot of their identity does as well. So the personal side is incredibly important.
Okay. Well, that's pretty straightforward then. So, I've actually seen some research on this, by the way, that show that people, maybe it's causation versus correlation, but people that work longer tend to have lower chance of a lot of illnesses as well, things like dementia and all that sort of stuff. So definitely, as well as the financial side of things. So we've got 8 years away, say, from Ralph hitting 60, 9 years for Jane. Realistically, 450 grand left on the mortgage, a credit card. Can they retire tax-free and with the 1.2 to 1.6 million?
I initially thought no, But then I realised when you were introducing that they were getting an inheritance as well.
Yeah.
And that's kind of a long forgotten. I think maybe you back tested this before you gave me the scenario.
No,
so
I just made it up.
would test me in advance. I think that inheritance point is an important one though, because most people that we meet haven't factored in that they're going to inherit a significant amount. And I think the next generation is the biggest transfer of wealth in history. So if you know you're going to inherit 300,000 or 500 or $1 million or more, will you change the way you act based on that? I know you don't know when you're going to get it, but you probably can slightly change your investment approach, the way you live, maybe buy that slightly bigger house with some level of comfort, even if you know it's not coming for a decade or more. I think they're actually in a reasonable position. So the first thing I said is they probably save around 40 grand a year, if that was a fair assumption. So if you sold all your assets, paid off your mortgage, you could probably save an extra 160 grand before retirement. 4 years, take you about 900,000 in super. If you add your $300,000 inheritance when that comes in, you get to about 1.2 million, and that's without considering investment returns in that period as well. So without the inheritance, I thought they'd probably need to work a bit longer. But when you start factoring that in, and then you've obviously got potential for a downsizer to top up their balance at some point in the future as well.
Yeah. Do you see that? Is that common for a lot of your clients to downsize and then use that contribution into super?
Increasingly, over the last, I think there'd be probably 25% of our clients have downsized in the last 2 years.
Oh, wow.
Most probably have a holiday house and a principal residence, and they downsize their principal residence, buy something easier to manage in the city, apartments, and then obviously you can downsize. As long as you've held the property 15 years, you can downsize for as long as you want, as old as you want. So
there you go. Yeah, I love the every time the government comes out with a new rule, it basically just means that properties are just recycled and the baby boomer generation can just sell the bigger house and move into the smaller one that maybe the first home buyer could have afforded, but now has no chance.
Stamp duty is a problem there.
Yeah,
that's another one.
Yeah, it's a killer. That's why some states are dropping it, right?
That's why no one wants to sell either, because they have to pay when they buy.
For sure. Now land taxes are coming in. That's a bit of friction for a lot of people in property too. We actually glazed over something here. So they have $185,000 in investment portfolio. They've got IVV, the ETF, the S&P 500, VAS, Aussie shares, Argo, which is like blue chip shares. They've got Magellan, which is the global fund in the ETF form or like the listed fund form. They've got BHP shares, 25 grand of that, 20 grand of CBA. And then they've got a crypto ETF of 5 grand. What do you make of that? Would you just would you sell that and then put it in super, or what would you do with that?
Depending on their priority and capital gains, the first thing I said was there's a bit of overlap there. So the biggest holdings in VAS and Argo are CBA and BHP. So I'm guessing they inherited CBA and BHP, but you'd probably just consolidate those. If they're keen on reducing their mortgage, sell them, put it into the mortgage. That'll free up savings capacity. Then you can then pay off your mortgage quicker, pay less interest, and then contribute to super quicker. That's the most conservative way. And then the other one, in the back of your head, you say, well, essentially they're just leveraging, because that 185 is essentially the equity they've got in their home. That it's just a leveraged share portfolio. That most people probably don't think about it. What
about when the mortgage, say, gets down? So that roughly would take it down to $260,000 in the mortgage.
Yep.
Would you keep the mortgage, even if they pay the mortgage down to $1 or whatever? Is that a pretty common strategy where people keep the mortgage open?
I think, most people are afraid of debt because they've spent their whole life trying to pay it off. Yep. But it's becoming more and more difficult to get a loan after you retire and you're 60, 65 plus.
Yeah.
But it's incredible. It's reasonably cheap capital. You can draw on it whenever you need to. So where possible, you definitely keep it open.
Yeah. Even if there's a couple $100 of fees.
If you need to put a deposit on when you go and buy your downsize house, because a lot of people buy the downsize before they sell. Yep. You've got additional flexibility there.
Yeah, cool.
Whether the bank lets you do it is another story.
Final curveball is this crypto ETF, $5,000, mate. What are they going to do with that?
When do they buy it was the first question. Probably in November last year. Or
November 2021.
At the peak.
Yep.
I mean, you can't say no to everything. So what our general view is get your core right. So make sure your super's invested appropriately, your equities are invested appropriately, and then this is something you believe in, something that's fun, but it's outside your core. So just let it roll. What do they say? Hold on for dear life. Is it?
Let it rip back up, they say. Okay, so crypto, $5,000, it's make or break. Mate, this has been a bit of fun. I imagine you have a lot of clients that present with similar situations, maybe like you said, a little bit older. But I hope people that were listening also got a fair bit from this, because that are potentially younger, because it's actually really good to see it in practice, to zoom out of stock by stock or ETF or fund by fund and actually look at the whole pictures. It's really interesting, and I think it's interesting, and not enough people pay attention to everything else.
Yeah.
They often wait until their 40s, 50s or 60s to get advice, to consider all the other things that they have at their disposal.
Well, there's a cartoon of someone visiting a financial advisor for the first time before their retirement date. And it says, here's your chance to be a hero. No planning whatsoever. Just give it to the advisor on retirement date and hopefully you're all good.
Yeah, she'll be right. Yeah. Whereas just even just a few of these things, if we're talking about super, debt, whatever, makes a massive difference. So by the way, if you're listening and you would like to revisit this, you can go into the show notes where you'll find the case study, but also links to the Wattle Partners website. And stay tuned for episode 5 of Passive Income, where we answer your questions. Please send them in, podcast@rask.com.au. That's podcast@rask.com.au. Drew, Meredith, CFP, thanks for joining me on the show.
Thanks again.